So hello everyone, and I hope you're doing well. So this is part 1 of chapter 2. I just want to make a quick video to go over some of these slides. So there's a term here there's two different terms. One is called direct finance and the other is called indirect finance. And direct finance simply refers to when you're borrowing funds directly from lenders in financial markets, such as if you're buying bonds, right, directly from a company, or buy or that type of stuff, So there's a nice slide here. Let me show it to you. So here's a great slide, right? So if you're basically going to be buying directly, this is direct to blue. So if you're buying directly from financial markets, you would be getting a broker, let's say, and you would be buying shares or bonds, let's say, right? Now, indirect finance, even though it may be a little confusing, financial intermediaries more or less mean this would normally be a bank or a mutual fund or a pension fund you would be buying from, or like TIA, Craft Insurance Company. Okay, so this you're buying indirectly through some intermediary. Here you're buying directly from the financial markets, I guess through a broker, or if you have Robinhood, or like I use Fidelity or TIA, Craft, brokerage. So if you're going directly to the financial markets, or if there's an IPO, let's say there's an IPO, and you're buying shares directly from the company, again you'd be going through an investment bank. So there's sometimes there's a little overlap here. But for the more or less, if you're buying through a company that sells like mutual funds, and you're buying shares or in exchange traded funds, that would be considered indirectly buying. All right, so everyone should know that basically debt instruments are bonds, otherwise known as bonds, and they have a maturity when you get your money back. You borrow money, and the company borrows your money, and you get coupons, otherwise known as interest payments. And then when the bonds mature, you get your money back. And equities, stocks, and you're a shareholder, and you may or may not get dividends depending on. You have to read and make sure you're going to get a dividend. For instance, Google doesn't pay dividends, right? So primary and secondary markets refers to if you're buying the stocks from the primary market. Basically, you're going through an investment bank through an IPO, an initial public offering. And secondary markets basically refers to you and I buying stocks from each other, buying and selling. And we go through brokers and dealers, as I mentioned, let's say online trading. Okay, so. All right, so there's different types of markets. So the New York Stock Exchange and the Chicago Board of Trade and even NASDAQ is considered financial exchanges, even though NASDAQ is traded on computers, okay? And it's sometimes they'll call NASDAQ over the counter from historical purposes, but it's not really. It's just nomenclature. It's really an exchange. It's just computer traded. And over the counter would be foreign exchange or buying on the Fed funds through the Federal Reserve. All right, so basically money markets deal in short-term debt instruments such as treasury bills and commercial paper, where companies buy and sell debt from each other for short-term, up to 270 days. Capital markets will deal in longer-term debt and equity instruments such as long-term bonds and long-term treasury bonds and and stocks. That's considered capital markets, a year or more. So here's some money market instruments, as I mentioned. Here is treasury bills, and here's bank CDs. Okay, and here's the commercial paper market, where companies will basically take short-term loans from each other, and there'll be an intermediary. There are dealers who deal in commercial paper. So here's some capital market instruments, right? Stocks, mortgages, bonds. These are capital market government securities, large bank commercial loans, and this is the dollar amount here. And of course, now we've gone globalized, and there's foreign bonds. There's all types of different foreign bonds, whether or not they're considered foreign, and how they're denominated, in whose currency and where they're sold. And there's all these terms. And then there's currencies, right? So euro dollars would be US dollars, basically deposited in foreign banks outside the United States or in foreign branches of US banks. And of course, there's stock markets way beyond what we know of in America, right? There's stock markets, Hong Kong and Japan and England. So indirect finance is basically buying through intermediaries, that's mutual funds. And they say lower transaction costs. These slides are a little old because now you can buy like through Fidelity directly, right? And don't pay any transaction costs. And basically, if you're not getting, they'll deal indirect finance. Basically, the mutual funds will basically deal with the asymmetric information problem because they get most up to date information, right? Asymmetric means we're not all getting the same amount of information, and there may be some moral hazard associated with that. Okay, so basically, it makes sure the borrower doesn't engage in activities that will allow them to repay the loan. So the bottom line is this. The intermediaries, such as mutual funds and ETFs, right, allow small savers and borrowers to benefit from the existence of financial markets. We don't all have millions of dollars where we can put money in hedge funds and so here's some financial intermediaries, right? Mutual savings banks and depository institutions here that they show you. And here's the life insurance company and the pension funds. Right? Finance companies, TIAA, CREF does and the commercial paper. Here's the mutual funds we previously discussed. And you could even buy money market instruments through mutual funds. Right? Through intermediaries. All right, so that's about it. You can pick the rest up on part 2. Have a good day.